Hey guys, welcome back to the Bitcoin Fortress podcast. It is Sunday, April 12th, 2026, and we are at block height 944765. Moscow time is 1408, and fees are 1, 1, and 2. This is episode 211 of the Bitcoin Fortress podcast, building one block at a time. As always, we'll start with the top Bitcoin news for the week from April 5th through April 12th and try to focus on the high signal that matters to Bitcoiners. After that, we'll get into the themes of the week from Bitcoin Podcast Universe. Then we'll highlight a featured Substack post, mention the books, and wrap it up. This was another week where the story was not just number go up or number go down. The bigger story was market structure, institutional plumbing, macro pressure, and the ongoing question of who is really buying Bitcoin here and who is selling it. We also saw the quantum conversation stay front and center, which is important because it is one of those topics that can very easily become either lazy fear-mongering or overly casual dismissal. And this week, Wall Street continued to inch deeper into Bitcoin, with Morgan Stanley launching its own spot ETF, even as overall institutional participation looked a bit uneven. Jumping right into the news, macro structure, macro, and flows. Strategy disclosed that it bought 4,871 Bitcoin for about $329.9 million between April 1st and April 5th, pushing total holdings to 766,970 Bitcoin. The point here is not just that Saylor bought again, it's that he bought into weakness after a pause and did it while the broader market narrative was still fragile. That reinforces the idea that the corporate treasury bid is still there, but it also raises the question of whether even a very aggressive buyer like Strategy is big enough to move the market meaningfully on its own anymore. The old version of the Strategy story was that every purchase felt like a major market-moving event. The newer version is more interesting. Strategy is still massively bullish, still stacking, still broadcasting conviction, but the market is now large enough and structurally complex enough that even a 9-figure purchase can be partially absorbed by other sellers, deleveraging, and macro-driven repositioning. That is actually a sign of Bitcoin maturing. It means one company cannot simply drag the market around forever. Strategy also reported a $14.46 billion unrealized loss for Q1. The company's latest disclosure reflected a massive unrealized loss on its Bitcoin holdings for the first quarter, driven by fair value accounting after Bitcoin's sharp decline during the period. Yet the stock still rose after the announcement, which tells you investors are increasingly looking through gap volatility and focusing on the long game, Bitcoin per share, capital access, and optionality. This is one of the best examples of why Bitcoin confuses traditional finance. An accounting loss looks ugly in a headline, but if the market understands it as mark-to-market noise rather than a sign of permanent impairment, it can shrug it off. Bitcoiners understand this intuitively. The real question is not whether Q1 looked bad on paper. The real question is whether Strategy can keep financing itself intelligently enough to survive the drawdowns and still accumulate through them. CoinDesk argued that Strategy's buys are not moving the market the way they used to. One of the more useful pieces this week made the point that Strategy's accumulation is now only a slice of total market flows, and it can be overwhelmed by larger forces distributing supply or pulling liquidity out of the system. That matters because it helps explain why bullish headlines can coexist with sluggish or choppy price action. This is healthy for Bitcoiners to internalize. We are past the phase where one charismatic billionaire or one treasury company can single-handedly define the cycle. Bitcoin is increasingly being shaped by ETF flows, macro liquidity, derivatives positioning, long-term holder behavior, and geopolitics. That means the market is less retail story driven and more reflexive with the broader financial system. In other words, Bitcoin is harder money, but also a bigger market with more moving parts. On April 6th, U.S. spot Bitcoin ETFs brought in roughly $471 million, the biggest one-day haul since February. That was one of the clearest signs this week that institutional demand did not disappear, even if it has become less consistent than it was during the hotter phases of the cycle. ETF inflows still matter because they represent a simple bridge from fiat portfolios into Bitcoin exposure. But I think the deeper point for Bitcoiners is this: ETF flows are not a clean adoption story. They are a plumbing story. They tell you whether allocators, RIAs, institutions, and momentum-driven capital are leaning in at a given moment. They do not tell you whether those buyers understand self-custody or whether they will hold through pain. So it is a useful data, but it is not the whole story. Just 2 days later, the block reported that spot Bitcoin ETFs posted net outflows overall, despite Morgan Stanley's new MSBT drawing about $31 million. That contrast captures the current moment well. New products are launching and drawing attention, but the broader ETF complex is not yet back in sustained momentum mode. This is classic late cycle or mid-reset behavior. New entrants arrive, the infrastructure keeps improving, the long-term institutional path is clearly still forward, but flows become more selective and less euphoric. Bitcoiners should probably welcome this. It is better than a one-way mania built entirely on weak hands. Morgan Stanley's MSBT debuted this week as a low-fee spot Bitcoin ETF, and by several reports, it drew about $34 million on day one. Symbolically, this is a big deal. A major Wall Street bank now wants its own branded wrapper for Bitcoin exposure rather than just distributing someone else's product. This is another reminder that Bitcoin wins even when the path is messy. Many Bitcoiners understandably distrust Wall Street's encroachment, fair enough, but from a network perspective, every new wrapper, custody route, and distribution channel makes it harder for the old system to pretend Bitcoin is fringe. The irony is that the same institutions that once laughed at Bitcoin are now fighting over basis points to offer their clients access to it. CoinDesk reported that JP Morgan estimated digital asset inflows at around $11 billion in the first quarter, far below the pace seen in 2025. Softer CME activity and weaker investor demand were part of the picture. That is not great short term, but it does fit with what many Bitcoiners already sensed. 2026 has had more digestion and more rotation than straight line enthusiasm. This supports a broader thesis that Bitcoin is in a reset and reaccumulate phase rather than a dead phase. The market often needs to work off leverage, weak narratives, and lazy expectations before it can make the next real move. Slower inflows do not mean the thesis is broken. Sometimes they just mean the market is trying to decide whether this is still a trade or increasingly a strategic allocation. The block reported that average daily CME Bitcoin futures open interest dropped to the lowest level in roughly 14 months, reflecting a basis trade unwind and weaker institutional engagement. This matters because CME is one of the clearest windows into the more traditional institutional behavior around Bitcoin. When CME softens, it suggests some of the cleaner Wall Street carry trade and hedging appetite is stepping back. That does not automatically mean bearish price action, but it often means less mechanical support and less institutional urgency. For Bitcoiners, it is another reminder that not all institutional participation is equal. Some of it is genuine conviction, some of it is just spread capture. One of the sharper pieces this week argued that the market currently has one group buying weakness and another group distributing into strength, especially against the backdrop of war, macro uncertainty, and selective ETF demand. In other words, the market is not unified, it is contested. This is CoinDesk piece that said the Bitcoin market is splitting in two. That sounds obvious, but it is actually useful. It means price action right now is not giving a clean signal because different constituencies are acting for different reasons. Some are buying Bitcoin as an apolitical reserve asset. Some are selling because they need liquidity. Some are reducing risk because of war. Some are adding because they think the macro response to war eventually means more money printing. That kind of split market often precedes a more decisive move later. After U.S. core CPI rose 0.2% in March, below expectations, Bitcoin moved up toward the low 72,000s. The market clearly still cares about inflation data because it informs the path of rates, liquidity, and risk appetite. This is one of those moments where Bitcoin can look schizophrenic if you do not zoom out. On the one hand, Bitcoin is supposed to be a long-term answer to fiat debasement. On the other hand, in the short run, it still trades partly like a liquidity-sensitive macro asset. Both things can be true. Bitcoin is the escape hatch from the system, but it still has to pass through the pricing machinery of that system every day. CoinDesk reported on April 12th that Bitcoin slipped back below 71,000 as geopolitical risk intensified around the Strait of Hormuz. Earlier in the week, Bitcoin had also rallied on ceasefire hopes before momentum cooled again. The message is simple. In the short term, macro still has the steering wheel. Bitcoiners should not be surprised by this anymore. Bitcoin is global, liquid, tradable 24/7 and increasingly institutionalized. Of course, it is going to react to war, oil shocks, rates, and headline risk. It also trades 24/7, 365, so you're going to see weekend action, good and bad. The better question is what it does after the initial shock. Does it recover faster? Does it attract stronger hands? Does it increasingly behave as an escape valve from the fragility of sovereign finance? That is the real story to watch. One of the strongest market structure pieces this week noted that realized losses have dropped sharply from around $2 billion per day to roughly 400 million, suggesting the wave of forced selling may be fading. That does not guarantee an immediate breakout, but it does suggest the market may be wringing out the weaker hands, the paper hands. This is important because bottoms often form not when everybody feels great, but when the sellers become exhausted. There is a difference between no buyers and no more panicked sellers. If the panicked sellers are largely done, the market can stabilize even before the bullish narrative feels obvious again. That is usually when the conviction gap between Bitcoiners and tourists gets exposed. On April 9th, CoinDesk reported that bullish option positioning around 80,000 had become increasingly prominent, alongside signs of whale accumulation. That does not mean the market is about to rip immediately, but it does show that sophisticated traders are starting to lean toward upside optionality again. This is one of those data points that matters more in combination than by itself. If you pair rising upside option interest with lower realized losses, a big ETF inflow day, and continued corporate accumulation, you get a picture of a market that may be quietly rebuilding a bid underneath the fear. Not certainty, just improving asymmetry. All right, moving along to quantum protocol resilience and Bitcoin's long-term defense. The block reported on April 10th that Starkware researcher laid out a way to create quantum-safe Bitcoin transactions without requiring a soft fork. Whether or not that exact path becomes the answer, the important point is that serious technical work is being done now rather than later. This is where Bitcoiners need to stay sober. The right posture is neither panic nor complacency, it is preparation. The value of proposals like this is not that they instantly solve the problem, the value is that they widen the menu of options and force the ecosystem to think concretely rather than abstractly. Bitcoin has time, but it should use that time well. The block reported that Bernstein views quantum risk as a future engineering challenge for Bitcoin rather than an immediate existential threat. That strikes me as closer to the right tone. It is serious, but it is not tomorrow morning. Bitcoin has handled contentious upgrades, social coordination problems, and major technical debates before. None of that means a post-quantum migration would be easy. It would probably be one of the most contentious technical social processes in Bitcoin's history. But hard problem is not the same thing as unsolvable problem. The market tends to oscillate between those two extremes, and both, quite frankly, are lazy. CoinDesk reported that Adam Back's view is basically the threat is not immediate, but Bitcoin should prepare now. That is a very Bitcoiner stance. Don't panic and don't procrastinate either. This is probably the most useful frame for us to think about. The threat is distant enough that nobody should be panic selling Bitcoin over it, but it is important enough that Bitcoiners should welcome serious R&D, scenario planning, and plain English education on the trade-offs. That will separate responsible builders from headline chasers. Next up, mining and grassroots signal. The block reported that a solo Bitcoin miner beat enormous odds and won a full block reward worth roughly $222,000. And I checked and it wasn't me. Darn it. Stories like this, though, always make people dream, but they also remind those of us that are listening that Bitcoin remains open. Even in a world of industrial mining, a solo participant can still occasionally win. The lesson here is not go mortgage the house to solo mine. The lesson is cultural. Bitcoin still preserves the magic of permissionless participation. You can run a node, you can mine, you can self-custody, you can verify everything. The system is industrial at the margins, but still radically open at the core. And that combination is part of what makes Bitcoin special. Moving on to the Bitcoin podcast universe, weekly feature that we do here. Here are the major themes. First up, we have debt, macro fragility, and sovereign stress remain a dominant theme. What Bitcoin did ran a Lynn Alden episode titled The Debt Crisis is Already Here, and then followed it with Jeff Booth on Everything They Told You About Money is Wrong. Even without needing every detail, the pattern is clear. Serious Bitcoin podcasts are continuing to frame Bitcoin not as a niche tech trade, but as a response to structural debt saturation, money distortion, and long-term sovereign fragility. Next theme, quantum, moved from fringe concern to mainstream Bitcoin discussion. This week alone, What Bitcoin Did ran Is the Quantum Threat to Bitcoin Actually Real with Alex Pruden, and TFTC ran The Truth About the Quantum Threat with Brandon Black. That tells you the issue has crossed over from technical corners of Bitcoin into broader media consciousness. Next, the conversation is getting more nuanced. Not quantum kills Bitcoin, but how would a migration actually work? The What Bitcoin Did description specifically mentions exposed public keys, Satoshi's coins, and the mechanics of migrating to quantum-resistant signatures. That is a healthier discussion than abstract doom. It means the ecosystem is finally asking operational questions instead of just arguing from vibes. Next, we have Europe conference culture, self-custody, and the institutional versus sovereign tension. These are all still live themes. Stefan Livera's recent BTC Prague episode with Matthias Kuchar focused on self-custody, CBDCs in Europe, regulatory challenges, institutional influence, and community divides inside Bitcoin. That is a good reminder that even in an ETF-heavy US cycle, the sovereignty and culture layer of Bitcoin is very much alive globally. Next, we have a strong current of optimism that institutional adoption expands, but that self-custody must stay central. Robin Sayer's recent episode titled Bitcoin Changed Forever, Strategy Buying 2 million Bitcoin captures one side of the moment. Corporate and institutional accumulation are changing the narrative, but the broader podcast ecosystem this week balanced that with repeated concern about self-custody, protocol resilience, and sovereign use cases. That mix is probably the healthiest possible one. And finally, Lynn Alden's framework is still echoing across the space. Swan Signal Live also featured Lynn Alden's new paradigm, which tells me the Bitcoin podcast world is still converging around the same broad frame. Debt, broken monetary plumbing, and the growing need for hard collateral outside the fiat system. That lines up very well, actually, with our featured post this week, which I will talk about next. And this piece is called Bitcoin versus Debt Monetization. It fits this week perfectly because so much of the last 7 days came back to the same basic truth. The global system is drowning in debt, policymakers are trapped, and every short-term solution tends to create more fragility down the road. Bitcoin remains the cleanest exit from that cycle because it is scarce, apolitical, and outside the balance sheet games. If you haven't read it, check it out. I'll put a link in the show notes to that, as well as all the articles that we covered in this week's episode. Also, if you enjoyed the podcast and my writing, check out the 3 Bitcoin Fortress books: Bitcoin Fortress, A Simple Guide to Bitcoin for Beginners, Bitcoin Retirement and Estate Planning, and The Bitcoin Lifestyle. Those are all available now in all formats on Amazon, links in the show notes, and great way to get a little bit deeper into Bitcoin from a practical and long-term perspective. Well, folks, that's it for episode 211 of the Bitcoin Fortress podcast. My big takeaway this week is that Bitcoin continues to get stronger even when the market feels conflicted. Strategy is still buying. Wall Street is still building products. ETF demand is uneven but alive. The quantum discussion is maturing, and the macro backdrop keeps reminding people why a neutral, scarce, censorship-resistant asset matters in the first place. So stay humble, stack sats, keep learning, keep building, and keep focusing on the signal over the noise. And thanks for listening to the Bitcoin Fortress podcast, building one block at a time. I will talk to you all next week. Bye-bye.